Hello viewers, so welcome to my channel. I'm Hasham. So far 6 videos I have uploaded on the introduction part of income tax. The first video I have explained you about what is tax, what are the different types of taxes, what are the canons of taxation, what are basic concepts used in income tax. And apart from that, agricultural income, all these provisions I have explained in detail in the previous videos. So if you have not watched, I suggest you go to the playlist of my channel. Select the subject income tax for the assessment year 23-24. Watch all the videos, be perfect about the introduction part. Then only you can proceed to solve the problems. Now in this video, I am going to explain you about the income tax rules and exemptions. That means what are the different rates of tax applicable to different SSCs. So presently, according to Income Tax Act 1961, every person who earns an income in India has to pay the tax if the income exceeds the basic exemption limit. So Income Tax Act has given the basic exemption limit. So whoever earns an income which is more than the basic exemption limit, he has to pay the tax. Not everyone. If the person's income exceeds the basic exemption limit. These provisions are same for the last year 22-23 and 23-24. No changes. Next year onwards it may change, but this year the provisions are same. So while watching the video, if on the board it is written 22-23, just ignore it because the provisions are same. Then for the current assessment year 23-24, the exemption limit of an SSC whose residential status is individual and residential status is resident is as follows. First of all, income tax depends on whether the person is an individual person or a company or a firm or an association of person like that. So right now we discuss only for individuals. And again, income tax depends on residential status. In the next video, I'm going to explain you about residential status. So resident or non-resident. So here I'm discussing about what are the different rates of tax if the SSC is an individual and resident in India. Non-senior citizen. We classify the persons, individuals, into 3 categories. Non-senior, senior and super senior. So who is a non-senior? Age below 60 years. So Income Tax Act says any person, whether men or women, the age below 60 years will be called as non-senior citizen. And the basic exemption limit is 2,50,000. The same basic exemption what we have in the last assessment year. This assessment year also same. Then senior citizen. A person whose age from 60 years but below 80 years. That means from 60 years below 80 years, the person will be called senior citizen. Age from 60 years to below 80 years. Basic exemption limit is 3 lakh. So if this person, senior citizen income exceeds 3 lakh, he has to pay the tax. Last one, super senior citizen. When a person's age is 80 years or more, they are called super senior citizen. And the basic exemption limit for super senior citizen is 5 lakh. Now heads of income. Income Tax Act has given the procedure of how to compute the total income. So incomes are classified into 5 heads. Income from salary, income from house property, profits and gains of business or profession, capital gain and income from other sources. First 4 heads are specific heads. So if any income does not fall in the first 4 heads, it is put to tax in the last head, income from other sources. Now elements of tax liability. In order to find out the tax liability, Income Tax Act says for the current assessment year, 3 elements are there. Basic income tax, then surcharge, then health and education cess. Basic income tax means on the total income, different slabs will be applied. By applying the different slabs and calculating the tax, that is called the basic income tax. On the basic income tax, surcharge will be added if the income is above 50 lakh. Up to 50 lakh rupees total income, no surcharge. If the total income exceeds 50 lakh and up to 1 crore, the surcharge is 10%. If the income exceeds 1 crore up to 2 crore, the surcharge will be 15%. If the income exceeds 2 crore up to 5 crore, the surcharge will be 25%. If the income exceeds 5 crore, the surcharge rate will be 37% of tax. Actually, surcharge means tax on tax. It is an additional tax collected by the government. So first we calculate the basic income tax. On that basic income tax, we calculate 10% or 15% or 25% or 37%, depending on the total income. Then we have health and education cess. After adding surcharge, basic income tax plus surcharge, on that total 4% is the health and education cess. The government of India is collecting an additional tax in order to facilitate the health and education purpose. Additional taxes are collected 4%. That is compulsory. Even if a person does not have surcharge on the basic income tax, only we calculate health and education cess. If a person is having surcharge also, to add a basic income tax plus surcharge. On that total, 4% is the health and education cess. Then health and education cess 4% of total income plus surcharge. Tax due. So how much is the total tax due? So tax liability minus TDS minus advance tax. So during the year, some tax deducted at source, TDS, and some advance tax might have been paid by the assessee. So from the total tax liability, deduct the TDS, deduct the advance tax, will get tax due. Now, if TDS and advance tax is more than the tax liability, then the assessee will get refund from the income tax department. Sometimes what will happen? The tax due, the tax liability is, let it be 5 lakh. 5 lakh rupees is the tax liability, but advance tax and TDS paid is 6 lakh. Already assessee has paid 6 lakh to the department, but the tax liability is only 5 lakh. So in that case, 1 lakh rupees refund will be made by the income tax department back to the assessee. So apart from this, so many provisions I have explained in this video. The provisions are same for last assessment year and this assessment year. So you can watch the complete video of this income tax rules and exemption. And the problems are based on the provisions of Income Tax Act. So these videos are very, very important. Apart from that, in theory, in examination, theory will be asked on this introduction part. So don't ignore. If you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject income tax for the assessment year 22-23. Watch all the videos regarding what is tax, what are the different canons of taxation, basic concepts used in income tax, and then agricultural income. All these topics I've already covered. In this video, I'm going to explain you about the basic rules, income tax rules and exemptions. What are the rules and what are the exemptions under Income Tax Act? So these provisions are very important for problems also. So before starting, take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Now see here, income tax. Income tax is a tax on the income of the people. So when a person's income exceeds the basic exemption limit, the person is liable to pay tax. And every person does not mean only individual. Person includes individual, HUF, partnership firm, joint stock company, association of persons, artificial body. All these are the persons. So every person has to pay the tax. If during the previous year, the income is more than the basic exemption limit. Now, see here I have written, income tax means the tax on the total income earned by the person during the previous year from different sources. It does not mean that a person will have the income only from one source. A person may have income from different sources. So So all the total income will be calculated from all the sources, and on that total income tax will be applied. So person includes all individual, HUF, company, etc. According to Income Tax Act, every person who earns income in India has to pay tax if the income exceeds the basic exemption limit. This limit is known as basic exemption limit. So the rule in India is every person whose total income is more than the basic exemption limit during the current previous year. For example, our assessment year is 22-23. Here it is. Assessment year 2022-23. So previous year for this assessment year is 21-22. It started from 1st April 2021 and end on 31st March 2022. So during this previous year, if the person's total income is more than the basic exemption limit, liable to pay tax. Now for the current assessment year 22-23, the exemption limit of an SSC whose status is individual and residential status is resident is as under. Now remember the provisions for the current assessment year, because you are going to write the examination for this assessment year 22-23. So for an individual, the provisions which I am going to explain will not apply for HUF or firm or company. This provision which I am explaining is only for individual, and the residential status of the person is a resident. A person may be resident or a person may be non-resident, but these provisions, this exemption limit will be applied only if the person's status is resident. Serial number, status of SSC, age in years, basic exemption. Income Tax Act has classified the SSCs into 3 categories according to their age. First category is non-senior citizen. Non-senior citizen is a person whose age is below 60 years. Below 60 years, not up to 60 years, but below 60 years. And the basic exemption limit for non-senior citizen is 2,50,000. First category. Second category is senior citizen. A person whose age is 60 years and more but less than 80 years. 60 years plus but below 80 years. The exemption limit is 3 lakh. Now super senior citizen. A person whose age is 80 years and above. 80 and above, they are called super senior citizen. And the basic exemption limit is 5 lakh. So 3 you have to remember. 2,50,000, 3 lakh and 5 lakh. 2,50,000 for non-senior citizen whose age is below 60 years. 3 lakh for senior citizen who is 60 and above but below 80. 3 lakh. And super senior citizen who is 80 years and above, the basic exemption limit is 5 lakh. You have to remember this, because these provisions we have to apply when we do the problems. A person who is liable to pay tax has to compute his estimated income, and periodically advance tax is to be paid during the previous year. The procedure of Income Tax Act is, Income Tax Act says a person has to compute his own income during the previous year. How much income he is earning during the previous year, he has to compute, and time to time he has to pay advance tax. His assessment will be done in the assessment year, but before that, during the previous year itself, he has to compute the income and pay advance tax. Then the concerned ITO assess the income according to provisions of IT Act and determine the tax liability. Then what will happen? The previous year will be over. After previous year, assessment year will begin. During assessment year, the income tax officer, the assessing officer, will make the assessment of that person and calculate the tax liability according to the provisions of Income Tax Act. Then, if the aggregate of advance tax paid and TDS stands for tax deducted at source. If the aggregate of advance tax and TDS is less than the tax liability, then the assessee is asked to pay the balance of tax. During the previous year, the assessee has paid the advance tax. Example, my tax liability, I am computing my tax liability. So for example, during the current previous year, I have already paid advance tax of rupees 20,000. 20,000 advance tax I have paid. Apart from the TDS, tax deducted at source. Suppose I am the employee of a company. While taking the salary every month, my employer has deducted TDS from my salary and paid that amount in income tax department on behalf of me. That is called TDS. Suppose my monthly salary is, let it be 65,000 or 70,000. Then what will happen? Every month some 5,000 rupees or 4,000 rupees are deducted. So during the whole year 48,000 or 50,000 rupees are deducted. So 50,000 rupees are deducted by the employer from my salary and paid it to the income tax department. I have paid advance tax 20,000. The total tax I have already paid during the previous year 70,000. Now, during the assessment year, the income tax officer assessed the tax and calculated the tax as 80,000. So already I have paid advance tax and TDS 70,000. The actual tax liability is coming to 80,000. Now balance 10,000 rupees I have to pay now. Income tax officer will ask the SSC to pay the balance 10,000 rupees now. That is the procedure. Now, if the aggregate of advance tax paid and TDS is more than the tax liability, then the excess amount will be refunded to the SSC. The opposite. During the current previous year, I have paid advance tax 20,000. My employer has deducted TDS 50,000. The total 70,000 rupees already I have paid. But when tax is calculated, the tax liability comes to 60,000. The tax liability calculated by the income tax officer according to the provisions comes to 60,000, whereas I have already paid 70,000. So the 10,000 rupees the income tax department will refund to the SSC. Then if an SSC is not satisfied with the assessing officer assessment order passed by the ITO, then he can appeal to higher authorities. If still he has not satisfied, he can go to court of law. The procedure in India is, if an SSC is not satisfied with the assessment order passed by the income tax officer. Suppose if the income tax officer has passed an assessment order that my tax liability comes to 80,000. I will fight. I will say no, it's wrong. Tax 80,000 is very high. According to my calculation, the tax liability should be 60,000. But you are imposing tax liability 80,000. I am not satisfied. So I will go to higher authorities. There are tribunals in the Income Tax Act where I can appeal against the income tax officer. I will make an appeal to the higher authorities that income tax officer is charging me 80,000, but according to my calculation it is 60,000. Then appeal will hear, the tribunal will hear the appeal from both the parts, SSC as well as ITO. Then will give the conclusion. If the tribunal says, no Mr. SSC, your calculations are wrong, whatever ITO is saying, that is correct. So still I can go to a higher authority. One more higher authority will be there in income tax department. I will make an appeal that this lower tribunal has given a wrong decision. I will not accept it. They will hear again. If they also give the same decision, I can go to the court of law. Then the highest court in India, Supreme Court decision will be final. No other court will entertain your case. The Supreme Court is the final authority to decide your case. So this is the procedure. Next, the Finance Act specifies the limit of tax-free income, exempted income. This 2,50,000, 3,50,000, 5 lakh. This is not same since a long back. It is only for the current year. Next year, these limits may change. So every year finance bill will be passed in the parliament. In that finance bill, the tax-free income or exemption limit will be fixed and different rates will be fixed. Next is the total income of a person is the aggregate of income computed under different heads. Income Tax Act says the income of a person can be divided into different heads, like income from salary, house property, like that. So the total of all the sources, that is called gross total income. Now each head of income has a method of computing the income under it. Income Tax Act has specified how to compute the income under each head. what is the procedure of computing the income under each head. Example, how to compute the income from salary, how to compute the income from house property, how to compute the income of business or profession. For each specific head, Income Tax Act has given the procedure. Next, all sources of income have been classified into 5 heads. Just now I told you, the total income of a person will be divided into 5 heads according to the income tax provisions. What are the 5 heads? Income from salary, income from house property, profits and gains of business and profession, capital gains, and income from other sources. These are the 5 heads. Now, first 4 heads are specific heads. First 4 heads: income from salary, income from house property, profits and gains of business or profession, capital gain. These 4 heads are specific heads. And the 5th head is a residual head. 5th head is income from other sources. That means if any income does not fit in the first 4 heads, Income Tax Act says that income is taxable under that income from other sources. The reason is no income should go untaxed. A person should not say, my income does not fit in salary, my income does not fit in house property, my income does not fit in profits and gains, my income does not fit in capital gain, so my income is not taxable. No, that income is put to tax under income from others. An open head is kept. Now, elements of tax liability. Now carefully you see. For the assessment year 22-23, the tax liability of an individual is the 3 elements. This is very important. This video is very important for computing the tax liability. So for the current assessment year, the tax liability can be divided into 3 elements. The first element of tax is the basic tax, basic income tax. Second is surcharge. Third one is health and education cess. Now, first of all, basic income tax. By applying the rates, we calculate the basic income tax. The rates of tax I'll explain you in the next video. Present video I have explained you about the basic exemption. Up to 2,50,000, no tax will be there. No tax. If a person earns 2,50,000 in the previous year or less than 2,50,000, not at all, no tax at all, right? If it is more than 2,50,000, different slabs are given. In the next video I'll explain you about the slabs. Applying the slabs, we calculate the income tax, that is called basic income tax. To this you add surcharge if it is there. Surcharge will not be applied to every person. Only if a person's total income exceeds 50 lakh rupees during the current previous year, then only surcharge. Up to 50 lakh rupees, no surcharge. Rates of surcharge will be different. From 50 lakh to 1 crore, over 1 crore to 2 lakh, 2 lakh to 5 crore, 2 crore to 5 crore, then over 5 crore, different such. Already I have explained you in the last video. Next is health and education cess. So after calculating basic income tax, add surcharge, we'll get the total. On that total, you have to add health and education cess. This is a mandatory tax. The health and education cess is 4% of the total tax. Health and education cess at the rate of 4% shall be calculated on the total income. So tax due is equal to, how to calculate tax due? Tax due is equal to tax liability minus tax deducted at source, TDS, minus advance tax paid. So to find out the tax liability, how much the tax due, take the total tax liability. From the total tax liability, deduct the advance tax, deduct the TDS. Remaining is the amount of tax due to the department. Now note, if TDS and advance tax is more than tax liability, then the assessor will get the refund of tax from the income tax department. If the person has paid more advance tax and more TDS than his tax liability, then whatever excess amount he has already paid to the department will refund the money to the assessee. Last one, for determining tax liability, residential status of person has to be considered. Based upon residential status, persons are classified into resident and non-resident. One more thing, the tax liability also depends on the residential status of the person. The Income Tax Act will not say that only Indian citizens have to pay the tax, foreigners are not liable to pay tax. It is not like that. The person's residential citizenship will be given by the Constitution. The Constitution will decide which person is an Indian citizen, which person is a foreigner. But Income Tax Act says who is a resident and who is a non-resident. So in the next video, I am going to take up this topic of residential status. In that, I am going to explain you when a person will be called as resident and when a person will be called a non-resident. So tax liability depends on this residential status. So presently, we divide into resident and non-resident. Residential status is determined for each previous year and it has to be based upon a number of days in India during the previous year. This residential status of an individual depends on how many days the person stay in India, on the land of India, right? During the previous year, current to previous year. So every previous year we have to determine the residential status. It is not necessary that once a person is a resident, always he will be a resident. No. In 1 year he may be resident, in another year he may be non-resident. So the residential status may change from year to year. So we have to find out what is the residential status during the current or previous year by seeing how many days he stayed on the land of India, right? Now, basic exemption limit. Particulars non-senior, senior and super senior. Basic exemption limit for resident person. Resident in India. In that case, the basic exemption limit is 2,50,000 for non-senior, 3 lakh for senior and 5 lakh for super senior. So these rules will be applied to a resident person. Whereas if a person is a non-resident person, then the basic exemption limit is same, 2,50,000. Whether the SSC is a non-senior or senior or super senior. So here non-senior, senior or super senior, the basic exemption limit is 2,50,000, 2,50,000, 2,50,000. For whom? Non-resident purpose, a non-resident SSC. That's all. So these rules you have to apply. We have to apply this in the problem. You have to remember all these rules. So in this video, I have explained you the basic income tax rules and exemptions. This topic will be continued in the next video, inshallah. So if you are satisfied, give a like to the video, share my channel among your friends, among your group, so that more students can watch the video and enhance the knowledge. Give your comments and subscribe if you have not yet subscribed to my channel. By the super thanks which is given below my video. Inshallah, we will continue our discussion in the next video.